What we're about to show you represents the largest institutional wealth destruction in American real estate history. And the mainstream media? They're staying completely silent about it. While everyone's been focused on individual homeowners losing equity, there's a much bigger story unfolding behind the scenes. Wall Street's massive housing bet, a $2 trillion gamble that began during the pandemic, is now collapsing in real time. And according to new data from Zillow, we're witnessing just the beginning of what could be the most spectacular institutional failure since 2008. But here's what makes this different from anything we've seen before. According to Zillow's latest report, 53% of homes are now losing value year over year. That's the highest share since April 2012. But when you dig deeper into who owns these declining properties, a disturbing pattern emerges. The institutional investors who bought millions of homes during 2021 and 22, when prices were at their absolute peak, are now sitting on what industry insiders are calling the mother of all bag holds. Let me break down exactly what's happening here because the numbers are staggering. During the pandemic buying frenzy, institutional investors purchased over 300,000 single-family homes. Companies like Invitation Homes, American Homes for Rent, Progress Residential, and hundreds of smaller funds went on an unprecedented buying spree. They weren't just buying a few properties here and there. They were acquiring entire neighborhoods, often paying 20 to 30% above asking price. And here's where it gets interesting. According to CoreLogic data, institutional investors paid an average of $420,000 per home during their peak buying period in 2021 and 22. These same properties, based on current Zillow estimates, they're now worth an average of $365,000. That's a $55,000 loss per property before we even factor in carrying costs, property taxes, insurance, and maintenance. Do the math with me here. 300,000 properties times $55,000 in immediate equity losses equals $16.5 billion in paper losses. And that's just the beginning. But wait, it gets worse. Much worse. These institutional buyers didn't just pay cash. Many of them leveraged their purchases heavily, borrowing against their existing portfolios to finance this buying spree. When you're leveraged 70 to 80% and your underlying asset value drops by 15%, you're looking at what Wall Street calls a margin compression event. In plain English, they're getting squeezed. But here's the part that should terrify anyone with a pension or 401k. The institutional money that flooded into housing wasn't just from private equity firms. According to SEC filings, major pension funds, including CalPERS, the Texas Teacher Retirement System, and the Florida State Board of Administration, invested billions into residential real estate funds during the pandemic. Your retirement money was used to buy houses at the absolute peak of the market. CalPERS alone allocated $2.4 billion to real estate funds that were actively buying single-family homes in 2021 and 22. The Texas Teachers Fund put $1.8 billion into similar strategies. These aren't small positions. They represent meaningful portions of retirement assets for millions of Americans. And now, according to the latest pension fund disclosures, these real estate allocations are showing negative returns for the first time since 2009. The Texas Teachers Fund recently reported a minus 3.2% return on their real estate investments, with significant headwinds expected through 2026. Now, here's where the Zillow data becomes absolutely critical. The areas where institutional investors concentrated their buying are exactly the regions seeing the steepest declines. Florida, Texas, Arizona, North Carolina, Georgia. These were the institutional darlings during the pandemic. And according to Zillow, these are now the epicenters of the housing value collapse. Please take 2 seconds to help us out and hit the like and subscribe if you find this video interesting so far. Each like, subscribe, and share helps support this channel and keeps us motivated to keep making you great content. Thank you. Now, onward. Take Florida, for example. Zillow reports that condo values in Florida are down 9.9% year over year, the biggest decline since 2009. Hey, that rhymed. But single-family homes, where most institutional money went, are down 4.9%. That might not sound catastrophic until you realize that institutional investors own an estimated 40,000 single-family homes in Florida alone. Allow me to get more specific about the metro-level carnage. In Tampa Bay, institutional investors own over 8,000 properties purchased between 2021 and 22 at an average price of $385,000. Current Zillow estimates put these same properties at $340,000, a $45,000 per unit loss. That's $360 million in equity destruction in just one metro area. Miami-Dade tells an even worse story. Institutional buyers acquired 12,000 properties at an average of $520,000. Today's Zillow estimates? $465,000. We're talking about $660 million in losses concentrated in a single county. But the absolute worst institutional performance is in Austin, Texas. Remember, this is where tech money met Wall Street real estate funds in a perfect storm of overpaying. Institutional investors bought 6,500 homes in the Austin metro at an average price of $475,000. Current estimates put these properties at $380,000. That's a staggering $95,000 per unit loss, totaling $617 million in equity destruction. American Homes for Rent, one of the largest institutional players, reported in their latest earnings that their Florida portfolio has seen material headwinds in property valuations. Translation? They're losing money hand over fist. But here's what should really concern you. These institutional investors aren't mom and pop landlords who can just sit tight and wait for the market to recover. They have shareholders, debt obligations, and quarterly earnings targets. When asset values decline this rapidly, they're forced to make difficult decisions. And the pressure is building from multiple directions simultaneously. Insurance companies that underwrote loans to these institutional buyers are now demanding additional collateral as property values decline. Wells Fargo recently sent notices to 3 major real estate funds requiring additional equity contributions due to loan-to-value covenant breaches. Bank of America quietly reduced credit lines for 2 institutional buyers by a combined $800 million. Meanwhile, the rating agencies are starting to downgrade real estate investment trusts with heavy single-family exposure. Moody's placed 4 major REITs on negative watch, citing deteriorating fundamentals in target markets. When your credit rating drops, your borrowing costs increase, which squeezes already thin profit margins even further. And we're already seeing the first cracks in the foundation. Invitation Homes recently announced they're exploring strategic alternatives for portions of their portfolio. Industry insiders know this is code for, we need to sell before this gets worse. Progress Residential has quietly listed over 2,000 properties for sale in the past 6 months. American Homes for Rent has suspended their acquisition program entirely. Now here's the part that affects you directly as a potential home buyer. When institutional investors start dumping properties en masse, it creates what economists call a liquidity event. Suddenly, markets that were starved for inventory get flooded with institutional quality homes being sold below purchase price. And according to Realtor.com data, we're already seeing this play out. Active listings are up 15% year over year nationally, with inventory now at the highest level since 2019. But here's the kicker. A significant portion of this new inventory is coming from institutional sellers who bought during the pandemic peak. This explains why we're seeing such dramatic regional variations in the market. States like New York, where institutional buying was limited, are actually seeing home values increase by 3.9% year over year. But in the institutional buying hotspots, the numbers tell a very different story. Texas, where institutional investors went on their biggest buying spree, now has 134,000 homes for sale, way above the long-term average. Tennessee, another institutional favorite, has 50% more inventory than normal. These aren't coincidences. What's happening is that institutional investors are quietly trying to exit their positions before the market realizes the full extent of their exposure. But there's a problem with this strategy. When everyone tries to sell at the same time, prices collapse. I did that with my mouth. And here's where that story takes an even darker turn. Many of these institutional investors used complex financial instruments to fund their purchases. Mortgage-backed securities, real estate investment trusts, pension fund allocations. The web of financial exposure extends far beyond just the housing market. According to Federal Reserve data, total institutional exposures to residential real estate now exceeds $2 trillion when you factor in all the derivative investments tied to housing. That's double the exposure we saw during the 2008 crisis. But here's what makes this situation potentially more dangerous than 2008. Back then, the crisis was driven by bad mortgages to individual borrowers. This time, it's institutional investors, supposedly sophisticated players, who made the bad bets. And unlike individual homeowners, institutional investors can't just walk away from underwater properties. They have fiduciary duties, debt covenants, and regulatory requirements that force them to take action when asset values decline. The National Association of Realtors predictably is trying to put a positive spin on all this. They're forecasting a market rebound in 2026, predicting double-digit growth in home sales and 4% price increases. But remember, these are the same people who said there was no housing downturn for the past 3 years. More importantly, the NAR represents real estate agents who benefit from transaction volume. They have a vested interest in maintaining optimism, regardless of what the data actually shows. The reality is much different. When you have $2 trillion in institutional money trapped in declining assets, you don't get a quick rebound. You get a prolonged unwinding process that can take years to fully play out. And we're only in the early innings of this unwinding. Here's what you need to watch for in the coming months. First, look for more strategic portfolio adjustments from major institutional players. When companies like Blackstone's Invitation Homes start talking about optimizing their geographic footprint, they're really saying they need to sell properties in declining markets. Second, pay attention to rental rate growth in institutional-heavy markets. These companies bought properties expecting 8 to 10% annual rent increases. As property values decline, they're going to push rental rates even higher to maintain their returns. This creates what economists call a rental displacement event, where rent growth actually accelerates even as home values fall. Third, watch for changes in institutional lending standards. Banks that financed these massive purchases are now looking at their loan portfolios with serious concern. Tighter lending standards for institutional buyers means less competition for individual purchasers like you. But here's the opportunity hidden in the institutional crisis. As these sophisticated investors scramble to minimize their losses, they're going to create buying opportunities that haven't existed since 2012. Properties that sold for $450,000 at the peak are now listing for $380,000, and based on current market dynamics, they'll likely settle closer to $350,000. The key is timing your entry correctly. According to our analysis of inventory trends and institutional selling patterns, the optimal buying window is likely to open in spring 2026. That's when the confluence of factors, seasonal inventory increases, institutional selling pressure, and continued demand weakness, creates maximum negotiating power for individual buyers. But you need to be strategic about where you look. The institutional selling is concentrated in specific markets and price ranges. Florida's Gulf Coast, Austin's suburbs, Phoenix's outer ring, Charlotte's growth corridors. These are the areas where institutional money is most desperate to exit. And here's something most buyers don't realize. Institutional sellers often have different motivations than individual sellers. They're not emotionally attached to properties. They're not trying to time the market for maximum profit. They're trying to minimize losses and meet portfolio requirements. This creates negotiating dynamics that simply didn't exist during the individual seller-dominated markets of the past. The bottom line is this: Wall Street made a $2 trillion bet that housing prices would continue rising indefinitely. That bet is now failing spectacularly. And according to Zillow's data, we're only seeing the beginning of the institutional wealth destruction that's about to unfold. For sophisticated buyers who understand these market dynamics, the next 12 to 18 months represent a generational opportunity. But you need to act strategically, focus on the right markets, and understand that you're essentially buying distressed assets from desperate institutional sellers. The housing market isn't just cooling, it's experiencing an institutional liquidation event that could reshape American real estate for the next decade. Are you positioned to take advantage of Wall Street's historic miscalculation? If you found this video interesting, please subscribe, share, and watch this one as well.